Yeah, I think that obviously the S-REITs are direct beneficiary from these lower interest rates. Since inception in 2021, the average annualized dividend yield is around 6% per annum. So it's quite stable and decent.
So back to what I was saying. Could be us.
So in recent weeks, we have seen quite a lot of developments in the financial markets. The US Federal Reserve just cut interest rates for the first time in 2025. And amongst the Beansprout community, we have seen a lot of comments around falling interest rates. How should we think about investing in this climate? So in today's Beansprout podcast, we are very pleased to have Mr. Bruce Zhang, the head of fixed income at CSOP Asset Management. Bruce, very welcome to the Beansprout Podcast.
Thank you, Gerard, and thanks for your invitation.
Maybe for a start, can you give a brief introduction about yourself?
Sure. I'm currently working at the CSOP Asset Management, as the head of fixed income, and mainly covering the bonds, REITs, real estate investment trust, and also the money market funds. And before joining CSOP, I started my ETF journey at State Street. I used to be in the investment team covering the Hong Kong Tracker Fund. And back to 2016, I moved to Singapore, starting to manage the Asian local currency fund ETF with a size of over $4 billion. And that's my start of the fixed income journey. And back to 5 years ago in 2020, I joined the CSOP, launching the world's largest China government bond ETF with the teammates, and also the S-REIT ETF in 2021. And after that, as the interest rates stay high for longer, before the recent cuts, our CSOP US dollar money market funds also grew to the largest Southeast Asia domiciled US dollar money market fund.
So I think quite a number of products that our readers are very familiar with, including S-REITs, money market funds. And based on your experience, how long have you actually been in the financial industry?
Wow, it started in 2008.
Okay.
Yeah, 2008 in the multi-manager firm in Europe, but at that time I was based in Hong Kong. Yeah, and then as I mentioned, in 2011, I started my ETF journey also in Hong Kong, but then it moved to Singapore. Yeah, it's already went through a lot of different cycles, even for fixed income.
So for myself, I started in 2008 as well.
Wow.
And I think, like you mentioned, we have seen a lot of cycles over the past few years. In particular, over the past 5 years, interest rates have been in the headlines a lot. Firstly, we saw inflation going to very high levels. Thereafter, it has tapered. A lot of the questions are around the interest rate cuts we have seen over the past 2 years. Maybe can you break down for our viewers, what is the interest rate environment that we are now in?
Wow, just as you said, the last 5 years quite volatile in terms of interest environment. We may start with a still reasonable level of the interest rate, but suddenly the break of the COVID lead all the major central banks lower their interest rate to almost zero. And it's only until maybe early 2022 when the Fed started to hike, then we experienced another extreme case, maybe the most aggressive rate hikes over the past 40 years. And then till the September last year, they start to cut again and restart its rate cut cycle maybe September this year. I think overall speaking, all else equal, when we see a lower interest rate environment, it should benefit the, let's say, the risky assets, particularly for those assets, let's say, sensitive to the funding cost and also sensitive to the interest rate environment. So overall speaking, I do believe now this restart of rate cut will benefit those risk asset class and also help the central banks elsewhere, not only the US. They leave more room for them to conduct the easing. But not all the central banks will follow the similar route. For example, the Bank of Japan, they perhaps still in a tightening cycle because of the, let's say, the reflation expectation or also the growth expectations.
It seems like people tend to have quite short memories because in the last few years, cash products like the Singapore T-bills and money market funds were very, very popular because it was in a high interest rate environment, right? And now that interest rates are coming down, the Fed cuts rates, we noticed that these products have also yielded lower rates as time went on. And so what does the current environment mean for cash and short-term products like this?
Well, I think you raised a very good point because year to date, the interest rate, they declined very fast, over the past several months. So for those, let's say the investors used to hold cash or used to hold short-term investments, but if they still seek for yield, then they have to consider different ways. For example, they may extend their duration maybe from a money market fund to a credit fund, or they may even lower their, let's say, the underlying investments credit quality. Maybe previously AAA, AA, now they may think about the BBB or even BB. And they can also even consider to switch from a non-Sing dollar short-tenor investment like the US dollar money market fund. Despite the recent rate cut, it can still yield at around 4% net of fees. And also from a credit quality perspective, although the currency is different, but the underlying also super safe at the current stage. But anyway, the investors, when they consider different yield alternatives, they also need to measure whether the yield pickup could compensate their, let's say, the potential credit risk or the less liquidity risk or even the FX risk.
Okay, good to know. Yeah, that there are options.
So I think the risk factor is something that we have shared often with investors in terms of how we consider different products. On the other extreme, like you mentioned earlier, we have seen some of the growth sectors doing very well, particularly US tech, Hong Kong tech stocks. What is actually driving the strong performance in some of these stocks?
Yeah, I think you raised also a very, very good question. Yeah, because the US tech boom or the technology stock rally, they started from a high interest rate environment, which means the high interest environment didn't hurt those stocks, but rather it's a reflection of the continuing growth story of the underlying technology stocks, thanks to this AI boom. I think the launch of the ChatGPT and also in turn the launch of the DeepSeek, they changed the industry a lot because they create a lot of, let's say, the usage or application scenarios for those, let's say, tech leaders to develop their existing platform or existing softwares. And these will and also in turn help those upstream industries like the hardware leaders and giants, which, for example, let's the chip producers like the NVIDIA and also TSMC, these kind of firms. So I think regardless of the interest, whether the interest rate is up or down, the technology stock will always have a fundamental to support their long-term story. But all else equal, the lower interest rate anyway will benefit those growth stocks because most of the tech stocks are actually the growth stocks. And this kind of rally also drive the strong rally in Hong Kong and China stocks, let's say, initially led by the DeepSeek, but now it's more like a investor gradually switch their existing investment to the China and Hong Kong stock markets because within China, there's also a lot of application usage scenarios, and despite the macro recovery still under pressure, but those soft tech giants, they are still getting more market shares and still see some improvement in terms of their earnings. So from this perspective, I think this at least tell one story to us: the China or Hong Kong tech rally can be ahead of the China's broad-based macro rally, and investors may use a different approach to access these kind of opportunities. For example, we launched one ETF tracking the China Hong Kong tech growth back to year 2020, and now it already grew to over US dollar 9 billion size, and with the daily exchange trading volume, let's say for year 2024, it's already 780 million, which means every type of investor, whether institution, retail, high net worth, they can easily buy and sell on exchange to get these exposures.
I think likewise, we've also seen the Southeast Asian tech stocks doing well. After the dip that we see in 2021, some of the major tech names in the region have also recovered quite strongly as well.
Yeah, That's another interest development, because when we talk about the Southeast Asia tech, maybe what's in our mind is, let's say, the grab and see, but there are more, let's say, the unicorns actually that they are emerging in this region, because we do believe that the Southeast Asia tech, they benefit from two major themes. They are really strategic themes to support the case. One is about the supply chain shift. Let's say because the supply chain used to be in China, or it used to be previously in the United States with the high cost. Now they're gradually shifting to this Southeast Asian region, because the whole region actually has the different layers of the supply chains, from, let's say, the relatively labor-intensive area like Indonesia, Malaysia, to these middle end, let's say, developing areas like Thailand, and also the high-end area like in Singapore. I think that's the one case. The other case is from the region's demand, because the region has maybe one of the largest young population in the world, and also the rising income together with the rising middle class. So this creates a lot of potential demand through these so-called platform economies. So that's why how this Southeast Asia themes can also work. Sometimes we typically treat this as the Southeast Asia's Hang Seng Tech or Southeast Asia's Nasdaq, because what's behind those names is actually also the investors are also from the China tech giants, or even the US tech giants.
How can investors then gain exposure towards these Southeast Asian tech names without having to pick single stocks?
Yeah, I think investors can definitely pick the single stock, but they may face some challenges in terms of access issue, right? Like for the stocks other than the Singapore stocks, and also the potential liquidity challenges. So in addition, or to this kind of single stock picking, I think investors could use the ETF vehicle. For example, back to year 2023, we launched the Southeast Asia Tech ETF, both in Singapore and cross-listed back to onshore China. And since then, we tracked a lot of interest both locally and also from the onshore Chinese investors.
What are some names within the ETF that investors can get exposure to?
Yeah, as I mentioned at the beginning, definitely the grab and see those ADRs they can access, and they can also get access to the Indonesian firms like the Astra, the EV or the car producers, and also some of the Indian tech names such as Infosys, because they also dominate the IT outsourcing business in the world. So this means through one ETF, investors can get different types of the software giants or even some hardware manufacturers in one portfolio, and to benefit from the long-term growth of this sector.
And this is like a very diversified exposure for investors, so it helps to, correct me if I'm wrong, help minimize the risk of country exposure or single stock name exposure, right?
Yeah, I totally agree. It's mainly cover the 5 ASEAN countries, but we only focus on those rising companies and leading companies with the improved liquidity as well.
For investors who might not be familiar with what an ETF is, can you explain to us what is an ETF?
Wow, ETF in full is an exchange traded fund, which means as compared to the traditional mutual fund, the ETF can be traded on exchange like stocks, which means investors, as long as they have a stock, let's say the brokerage account or stock trading account through a broker on SGX, they can easily trade those ETFs without touching the underlying. And not, as I said, not only the equity has the ETF vehicle, even the fixed income or even the real estate investment trust, the REITs, they can have the ETF vehicle. So it's particularly convenient for the individual investors or retail investors if their size or their scale cannot reach the minimum size for directly trading a REIT or even a bond. They can use the ETF to enter this market to enjoy the potential capital gain dividend.
So one of the key themes we talked about with this interest rate movements would be the shift in performance across different asset classes. I think one asset class that has gotten a lot of investor interest would be the Singapore REIT sector. Given that the interest rate environment has actually impacted some of their distributions in the past, I think a question that we get very often these days would be, now that interest rates are coming off, would it actually benefit the Singapore REITs?
Yeah, I think obviously the S-REITs are direct beneficiary from these lower interest rates, because the lower interest rate they has two implications for S-REITs. On the one hand, all else equal, the lower, let's say the more friendly discount ratio will means the price rally. But second, which is more important, is that the lower interest rate means gradually lower funding cost, which can leave more room for those S-REITs to conduct more value-add, let's say the initiatives like the asset enhancement, like the M&A, and in turn they can rise their dividend payment. And in fact, back to September last year, the S-REITs funding cost has already peaked, which means back to that time, every new debt to roll, their cost is already lower than the previous debt rolled at the peak. And in addition to this peak of the interest rate, the peak of the inflation rate also leaves the central bank like MAS to conduct more monetary easing. That's why the Singapore SORA that has declined a lot year to date and also decoupled from these US peers year to date.
So one question that we get very often is that do REITs actually benefit from lower interest rates? And based on what you shared, you mentioned that we have already seen the interest rates peaking in September last year, which means that as the interest rates start to come down, that can potentially benefit the funding cost of the REITs.
Yeah, I totally agree. I think the beauty, but in addition to that, the beauty of the S-REITs, they can not only benefiting from these lower interest rates, they can also benefit from these, let's say, the fundamental change, particularly the rental reversions and also the supply demand dynamics, because the good news for now is that the rental reversions for most of the S-REITs are really favorable, because most of the REITs rental contracts, they were signed during the COVID period. But now, since they are going to be rolled, they have good chance to increase their rental fares to achieve the further growth. And also, in terms of the supply demand, this kind of outlook, I would say majority of the underlying S-REITs are like the industrial REITs, linked particularly for those REITs linked to the new economies like the logistics and also the data centers and also the grade A offices, particularly around this area, and also the retail REITs are both in the Orchard area and also the suburban areas. Their supply demand are still quite balanced, which means the supply not that much, but demand is still there. The only exception is the hotel REITs. Yeah, this is mainly because when the revenge spending faded away, the existing or the remaining demand is not strong enough to cover the previous supply, particularly given the high room rate. So this may take more time for those REITs to recover.
What about the REITs that a lot of people know about, which is like the shopping mall REITs, for instance?
Yeah, I would always mention the capital land, because they are not only having the exposures in Singapore, but even in China we see a lot of exposures from this sponsor. I think the shopping mall attractiveness in shopping mall in Singapore, the story is quite clear, because people would not like to stay home during the weekend, and also too hot for them to conduct some outdoor activities. And sometimes these, let's say, the shopping mall can also connect to the main office building, which means even for weekdays there may be a very stable the shopper traffic as well. So I think that's very important. And also, since Singapore, they relax some, let's say, the visa policies to China, to other countries, we see continuing people they traveling into the nation. So this part will particularly benefit those Orchard malls, including the capital land related malls. But what I like the Singapore retail malls is not only the let's say the CBD malls or the Orchard malls, but also the suburban malls, because every single area has its own their own CBD or their own shopping center, and these provide a lot of defensive features to the different market cycles. And this is very typical during the year 2020 and 2021, when people cannot travel out or even cannot travel to CBD that convenient. They can just go to the neighborhood shopping mall and support the suburban mall REITs continuously.
To play devil's advocate, I think on the flip side, many people are thinking that for the retail malls, they are facing headwinds because operating costs are going up, labor costs is going up, you've got more F&B closures. What's your take on that?
Wow, unfortunately, that's the case for some of the underlying tenants. But as long as those retail REITs, those owners, they have the dominant assets or they have the dominant locations, they can always, let's say, to attract new tenants to rent these the vacant place. That's why from a vacancy or occupancy perspective, except the hotels, all of them, let's say the retail or the office or even the industrial, they have a higher than 90% occupancy rates at the current stage. I think that's very important because these, let's say, this dominance in terms of asset quality and locations, they can not only attract these new tenants, they can also even pass these inflation pressure to the tenants or even end consumers. I think that's power of the S-REITs having these days.
So even if I take the view that interest rates are coming down, based on what you shared, there seems to be quite a number of factors I need to consider before buying into a REIT. I need to understand which sector is it in. Is it in retail, office, hospitality? Even if it's in retail, is it having a downtown mall, a suburban mall? So should investors go and look at individual REITs, or can they actually think about gaining diversified exposure?
Yeah, very good question again. Yeah, again, it's nothing wrong to, let's say, for investors to pick the, let's say, the individual REITs like the capital land, or even a data center REIT if you have a very strong or high conviction. But investors should always bear in mind that when picking the single stock or single REIT, you are subject to the potential upside, maybe huge, maybe small, but you're also subject to potential downside, which is the concentration risk. And also, as I mentioned, when investors trading the individual REITs by themselves, you may also subject to potential higher trading cost on the exchange. So that's why I think there are three factors supporting the case for holding the S-REIT or REIT ETF versus the single REIT stock picking. The first one is the relatively stable and predictable dividend yield. Taking our REIT ETF as an example, since inception in 2021, the average annualized dividend yield is around 6% per annum. So it's quite stable and decent. But if you pick the single stock, it may subject to a larger volatility. Sometimes it can be high, sometimes it can be low. And second is about the diversification. I think this not a new topic, but diversification did lower the volatility and lower the drawdown for investors, because even all the underlying S-REITs, they have different sector exposures. They have even different country exposure in terms of the project allocation. So that can diversify your risk and lower your total volatility. And lastly, again, it's about the trading. As I mentioned, is that if you invest directly trade or copy the basket, they can easily copy our basket because we publish our daily holdings on our website. Everyone can see it. But we are confident that we can provide a more efficient tool, because investors, when they directly trade them on exchange, they may subject to the beta spread as wide as 60 bips. But for us, the ETFs, it may only trade it 2 or 3 ticks, or maybe more than half of the reduction versus the investors' direct investments. So that's why the ETF tool can provide investor an efficient vehicle for them to allocate to these markets.
Earlier you mentioned this dividend yield number, and a question we always get from investors would be, is this dividend yield sustainable? Is it actually distributing from our capital, or is it actually coming through from the income from the underlying REIT holdings? What can you tell us about where this 6% is coming from, and whether is it something that is coming through from the capital of the underlying REITs?
Sure. I think a majority of these underlying yield is from the dividend yield we received from the underlying REITs holdings. Because now the MAS required underlying REITs, they at least pay 90% of their taxable income to the end investors. But how we treat those dividends, we 100% pay those dividends back to investors. But in addition to that, we will always pay the higher level of our portfolio yield received and the index yield, which means the bottom line is that regardless of which is higher, investor will at least achieve a same dividend yield as our ETF's benchmark.
What about, so, you shared a little bit more about the REIT ETF, and that could be quite beneficial for a retail investor who might not want to spend a lot of time researching on different sectors and going deep down and diving in, or going and visit the site of the warehouse or the data centers. What about investors who do want to take a position or a view? Is there any advantage in focusing on larger and more liquid REITs in the market?
Wow, that's why our ETF came for. Yeah, because our ETF now is tracking the SGX iEdge S-REIT Leaders Index. And in this index, we are not only tracking the largest REITs, but also the most liquid REITs. This could help us to always capture this so-called sector rotation from different market cycles. For example, when we launched this ETF in 2021, the liquidity or the market cap indicated weighting help us always those defensive sectors like the logistics REITs, like the data center REITs, like the suburban mall REITs. And during the time when Singapore finally reopened, let's say in the year September 2022, and thanks to these factors, these rule-based factors, we start to overweight those, let's say, the cyclical names like the offices, like the hotel REITs, and also the retail REITs. So what I want to say is that even in the passively rule-based ETF vehicle, investors can still benefit from this sector rotation and always have the exposure to the largest and the most liquid REITs with the rising attentions.
So if I'm a retail investor and I'm trying to understand how this ETF can fit within my larger portfolio, how should I think about how I can fit this ETF into a portfolio?
Yeah, I think suppose the investors, they have other asset classes and also have a single stocks. I would treat this REIT ETF as beta exposure, and also treat these S-REITs as somewhere between the bonds and also the equities, because in terms of the dividend yield, it's close to 6% dividend yield. It's attractive versus most of the equity peers, but the volatility is just less than 15% in terms of the annualized standard deviation. So it provides a defensive position as compared to their equity position, but as compared to their existing cash or short-term bonds position, it provides additional yield pickup and also provides the growth potential. Because if we purely talk about the cash or the government bonds, it's more of a reflection of the interest rates or yield change. But since the S-REITs or REITs in general, they have a growth component mainly through the rental growth and also some M&A activities, then it can be treated as a yield plus or fixed income plus product.
So I think you shared quite a number of different technical terms with us earlier. For those viewers who may not be familiar with some of these terms, maybe I can get you to explain some of this for us so that we can all learn along the way. The first one is beta exposure. What does that mean?
In simple, beta exposure is the broad-based market exposure specific to REITs or S-REITs. When I talk about the beta exposure, is about the broad-based market movements. That's how the ETF could capture. And when it comes to alpha, it means the additional return potential on the top of these market movements. Yeah.
In other words, what the ETF would try to do would be to be able to track the performance of the index rather than getting excess return compared to the index.
Yeah, in simple, the ETF is designed to track the benchmark across of fees. So yeah, all else equal, what the investor would have ideally is a benchmark return minus the management fee minus the total expense ratio. Then investor may ask why they need it if they anyway will get an index minus return. I think as I mentioned, because the ETF, they can save the trading cost from the underlying trading capability, then it can save part of the cost from there. And another one is more specific to our own REITs ETF, the SRT, because we, in addition to the daily tracking work, we can also leverage this, let's say, M&A and also this potential rights issue to get some so-called risk-free alpha through our trading scale, and these can reflect in our total return. And since inception, we almost offset all of our management fees and TERs, then which means investors can almost get this benchmark or market return without or with little cost.
One other term you used was yield pickup. I think this is particularly important for investors who are looking at different asset classes and where to park their cash. Could you share a little bit more about what a yield pickup means?
Yeah, they can be in different dimensions. First of all, is the yield pickup is mainly against this risk-free rate, which is now in Singapore is even less than, it's just around 1.4% for the short tenor. It's even less than China and Japan yield for now. But the S-REITs now, it can still provide 5.5%, so which means it has a 3.5% yield pickup. And this yield pickup can also means that versus other markets, like versus the US, UK risk market, which may yielding around 4%, 3%, or even versus Australia market, it can also yield more than 1 or 2%. So whether from a versus risk-free asset level or versus other peer risk perspective, we see the yield pickup for the S-REITs. But even we cross the different asset classes, let's say the deposit rate, right? Like the equity dividend yield, the S-REITs can still provide a decent pickup. So it can be crossed at time and across the assets.
So earlier you shared some of the things that a fund manager does. Maybe you can make use of this opportunity to share with us what you do at CSOP Asset Management, and also for investors who might not be familiar with CSOP Asset Management, what is the firm culture like? What does it really do?
Sure. We are one of the largest ETF providers in Hong Kong and Singapore. Although a majority of our product offerings are in the form of ETFs, I would rather treat our firm as a solution provider instead of index tracker. Taking the SRT, our S-REIT ETF as an example, during the index design stage before the launch, we are actively inputting a lot of factors like liquidity, market cap, to make sure our investment universe is more representable and also more tradable. And after the ETF launch, during the daily management, as I mentioned, we are not simply say, oh, we buy the same basket and we lie down. No, not like that, but we're actively seeking for these risk-free alpha opportunities. So without compromising the tracking error, we can add value on the top of these benchmark return. And also, maybe I can take another example from the Hang Seng Tech ETF, because now it's the world's largest Hang Seng Tech and most liquid ETF. So in addition to the index tracking, we are also work very closely with our partners, distribution channels to refresh them in terms of the market views. That's attract a lot of tensions in the market. For example, even back to year 2022-23, when the Hang Seng Tech or China-Hong Kong market under pressure, every time when we saw correction, we see more inflows, increasing shares into the portfolio. In Singapore, it's around 15 people, but each department have 1 or 2 representatives, and in Hong Kong, it's around 150 people. Already.
Oh, that's a lot.
Yeah.
Okay, we'll end off with some closing questions that are more personal finance focused. Given your experience that you shared with us, that you started in 2008, I think what our viewers want to be learning as well would be from your experience. So maybe you can share one tip for investors who are looking to start investing today.
Sure. I think this is also my personal tip as well. If, let's say, investors, they are optimistic or they are constructive on certain asset class, maybe today's REITs or maybe the US Treasury bonds, I think instead of all-in investing, right, you throw all your money into this asset class one time, I'd rather suggest investors to, let's say, invest in this asset class in batches, which means when certain asset class they see some corrections, you buy, and then you wait when they rise again, and over time you have a very ideal investment return stream. Yeah.
So even if I'm very positive on REITs at this point in time, I shouldn't be putting all my money into REITs.
Not in all at once, I would say, because if you look at the time series, right after this September 18th cut, we see some corrections, both from these U.S. interest rate and also from the S-REIT sectors, which means there's some markets may take some time to price in these rate cut expectations, and once they have another trigger, let's say the October rate cuts, or let's say there's some positive fundamental news in the industry, then it's a good time to invest in the asset class again. That's why when specific to the S-REIT industry, we always suggest investor to, in the past, we think that, let's say when PB is traded at 0.85, it's the bottom level, and when PB traded at 1, it's the fair level. But if it's traded at, let's say, 1.2, then investor needs to take some profit and then wait for the next correction and then go into the market again.
Yeah, I mean, aside from the current market conditions, I think investors also have to take into consideration their own personal circumstances, right? You can't just all into a particular asset class, but then you're not also looking at your risk appetite. You're not also looking at what your life circumstance might be, right?
Exactly. And also your average cost,
Yeah.
when entering this market.
So what's the price to book ratio of the Singapore REIT sector now?
Now it's slightly above 1, but we still believe there's some more room to go because the REIT card cycle is just restarted, and the fundamental story, at least for now, is not quite bad. So we continue to see some further upside potential from the current stage.
I think you've shared one mistake that investors should avoid, which is to put all their money into investing in one stock at one go. Are there other things that investors should avoid when investing?
I won't say they should avoid, but they can think differently, because sometimes individual investors, they always believe that when they invest in one stock or one REIT with their high conviction, and in a short-term period they can achieve their final target. But it's always hard to time it, because if you look back the history, there are always opportunities. Maybe you already missed the millions of dollars, but when you take this on a forward-looking basis, there are a lot of uncertainties here and there. So that's why, in addition to the single stock picking, which can add your alpha, add your high conviction return, you investors need to consider about the diversification, because diversification can always give you more sustainable total return through this stable dividend and more sustainable growth story.
Yeah. Earlier you shared. So there's another question I would have as a retail investor. Earlier you shared you had a very long and illustrious career in finance and in many different products as well as in different countries. What is one lesson that you can impart on people from your years of experience in finance?
Wow. My lesson is that I won't say that the investor should all be contrary to the broad-based market, but it's still important that don't be over optimistic when everybody's optimistic, and don't be over pessimistic when everyone is pessimistic. Like what happened during COVID, like what happened during the SVB bank crash, like what happened during the Liberation Day in April. Every time you see the rebound, from there. So try to be a bit contrary, but not exactly.
Thanks so much for sharing your philosophy when it comes to investing and also helping us to make sense of the interest rate movements. I think given the volatility we have seen over the past few months, those are really the questions that we see being asked a lot in the Beansprout community. Thanks so much, Bruce, for joining us today, and I hope you have a good day.
Thank you both. Thanks.
Thank you.